Hey guys, Joel Frank here, market analyst for YouTrading, and in today's video we're just going to be taking a quick look across markets, talking about what's going to be coming up in the week ahead, what the main theme's going to be, and how markets might be reacting. Before we jump into the calendar, let's have a look at the charts here. So this, you can see, is the dollar index. In fact, let me get the correct one so we can show what it's doing today. Yes, you can see the Dixie trade weighted basket of major dollar pairs like euro dollar, sterling, dollar yen, and some of the other ones. It's advancing to fresh highs since mid-July. It looks like it's gunning for this high of the year. It's above 108. Why? What's going on? Well, these themes which are boosting the dollar, and you'll see they're affecting other markets as well. We're talking about hawkish Fed. Okay, Fed speakers last week. Talking, some of them sort of differed in their opinions on how fast the Fed should be raising interest rates. 50 basis points, 75 basis points at the next meeting. I think there's a bit of disagreement there, and potentially in how high they think interest rates might have to go next year. But they were unanimous on the idea that rates do need to continue rising, and they're unanimous on the idea, or unanimous in their conviction that inflation must be brought under control. Okay, so ultimately, if inflation isn't coming down towards the Fed's target fairly quickly, interest rates are going to go pretty high. Okay, because any of the slightly more dovish Fed members, if they don't see inflation improving, then they will become more hawkish. That's pretty much what they're telling us. So a lot of this sort of hinges, for risk assets anyway, on inflation, the inflation situation improving. And the latest developments we've had on that front haven't been good. Okay, so for example, in Europe, you're seeing a fresh surge in gas prices, which is further worsening the stagflation, pretty much, that the Eurozone and, well, just the whole of the European continent is pretty much in. And obviously, that does have some knock-on impacts on other parts of the world as well. But it boosts the dollar as a safe haven, okay? Because when the European or other parts of the global economy are performing poorly, and the US economy is holding up a little bit better, that's an incentive to go towards US assets. And then obviously you got the Fed being more hawkish compared to the ECB and other central banks, and then the fact that the dollar is the global reserve asset, which means it's a safe haven. So yeah, all these things contribute into continued dollar upside, and I think it's probably likely that this is going to continue. Maybe not at the same pace. Maybe the dollar does get a little bit overbought. In fact, let's check the RSI. Let's see what the RSI is saying. Well, we're not even at an overbought territory yet for the dollar, or for the Dixie. Maybe if we get above these yearly highs and then press on towards 110, things might slow down. Then maybe you might get a bit of a pullback. But yeah, pretty much more dollar upside, I think, is pretty likely. Whilst we're on the topic of Forex, let's have a look at some of the other pairs. You can see euro dollar's fallen back to parity, pretty much bang on parity. It's eyeing these annual lows, and if you really zoom out, in fact, I'm going to need to go on like weekly charts probably. You can see if we do muster like a significant break below parity, well, the next sort of key area is around here, around 0.96. So that is potentially on the table this winter, well, heading into this winter, if the Eurozone energy crisis continues to get substantially worse, which it probably will, because of the tensions with Russia are so elevated amid the ongoing war in Ukraine. And the Russians are going to continue to try to retaliate by creating fear in energy markets and all that kind of stuff. So it's very possible. Let's look at sterling or cable. Sterling is also pretty vulnerable, hovering just above yearly lows. Let's get it back on a daily, actually. Not in oversold territory, yes, suggesting that a break below yearly lows and a bit of a push lower is definitely on the table. And then actually, if we go back to that weekly chart, you can see that the pandemic low during the pandemic panic, when everyone thought the world was potentially ending, that could be a target for the next couple of months, because the UK economy, if things are going bad in Europe, they're probably going to be going bad in the UK as well. The UK also facing stagflation. Let's move on to other asset classes. Look at stocks. Go back on a daily actually. Yeah, so we talked about how stocks were pulling back after hitting key resistance. Remember, that was in the form of this downtrend. Let's just draw that on real quick. Pretty much that. I think there was the 200-day moving average as well. That was pretty much bang in line with where we're talking about. Yeah, you can see the 200D MA there as well. And also, we got a bit oversold. So I think in my trade idea video that I did last week, if you might have seen it, I was talking about how a bit of a pullback is likely. I was thinking about potentially people might want to be buying the dip back to 4,200, but looking at the way that we've broken through 4,200 rather than stabilizing at 4,200, it's not looking good. And, you know, for all the reasons that we're just talking about, boosting the buck, hawkish Fed, concerns about the global growth outlook with all the crisis in Europe, and you need to chuck in worries about Chinese growth into the mix as well. It probably is likely that people might continue taking profit on equities after this big run-up that we had in the last couple of weeks. And there are still going to be a lot of people, given this technical downtrend that we're still in long-term, a lot of people still worried that this is a bear market rally, which it might end up proving to be. I mean, if inflation doesn't come back under control as much as the Fed wants, and then they have to start talking about interest rates at above 4% or above 5%, 6%, well then, you know, we could be headed very quickly back down towards these lows. But yeah, a lot's going to obviously hinge on inflation developments in the next couple of months, whether we do go back to these lows. Anyway, yeah, that's stocks. Finally, before we look at the calendar, oil also heading lower. Same sort of risk-off tone, stronger dollar. It's all weighing. We're very much still in this downtrend that we've been talking about now for weeks and weeks and weeks. In fact, you can probably even draw it as a trend line, more or less. Yeah, you can. Yeah, so things looking technically bearish, fundamentally bearish, because we're still talking about recessions in all these places, like in the US. Okay, US economic data recently has been a little bit better, but the yield curve inversion suggests that that recession is definitely on the way at some point, perhaps in 2023, and all this is just not good for oil. We're still gunning towards, or I think we're still gunning towards this area of support here, which we did pretty much hit it already, but yeah, maybe we can hit it one more time, and then maybe we're going to form a bit of a descending triangle here, and then see a bit of a bearish breakout below that level, in which case, yeah, I mean, you'd have to be marking up areas, the next sort of areas of support, like maybe around here, 80 or just under 80, here, 82, yeah, 82 per barrel for WTI. But yeah, these are some of the things I'm looking at. Quickly look at the calendar. Monday, today, quiet, nothing to worry about really, just monitoring the usual themes, central banks, energy related crisis things in Europe. But then we do get a lot of data tomorrow. The flash PMIs for August out of Eurozone, UK, US. Some tier 2 data on Wednesday out of the US, and Thursday, second estimate of US GDP, which, remember, we were chatting about how the US economy is in a technical recession in the first half of this year. Do we get some positive revisions? Does it maybe bring the US economy out of recession in the first half of the year? It's all very backwards looking, so it shouldn't really matter too much. But Friday is the big day, because first of all, we have core PCE, the Fed's favoured gauge of inflation. That's for July. That could lead to a further, I mean, if it does drop to 0.3% month over month from 0.6% in June, then that could help ease some inflation fears, which could be a much needed positive in this mostly risk-off market we're seeing at the moment. And then we've got Fed Chair Powell speaking at the Jackson Hole. Yeah, you can see the Jackson Hole symposium begins on Thursday, but then Powell's speech, which is like the main event within the Jackson Hole event, yeah, that's on Friday. And people are expecting he's probably going to be quite hawkish, because that's generally been the tone of other Fed policymakers. And the Fed especially the Powell Fed, likes to sort of work in a way where everybody's kind of singing from the same hymn sheet, if you know what I mean. Maybe there's a bit of differences over the exact policy specifics, but they're generally all united about things like the need for further tightening, the need to bring inflation under control, all these kind of things. That's the sort of message we're probably going to get from Powell. But yeah, guys, hope you enjoyed the video, and I'll see you all in the next one.